Manny, thank you for talking to Bloomberg.
Delighted.
PIMCO, 1.8 trillion under management. What do you think the chances of recession are next year in either the euro area or in the US?
So I think the US, the big picture is very simple. You have a trade war with China, and we don't think it gets fixed in the near future. I think the best parallel you can think of is the Cold War in the 50s, where there'll be improvement, there'll be contagion, there'll be ups, there'll be down, and so this is going to be interesting. And so
do you see two economies emerging? I mean, it's a division between the two. We were talking about this morning. Do you see kind of two internets, two supply chains, much more regional economy?
Much more regional economies, and also a global fight for some of the sectors. And so you think the U.S. is going to slow down, and you know, one of our main themes is that the first half of 2020 will be slow in the U.S. You'll see GDP dip to 1% or something like this, and if the rhetoric on the trade war gets worse, you may even be in recession simply because the consumer will lose faith in what's happening, and then you'll go.
You had a very interesting note last week from one of your guys pointing out that the Chinese, you think, will read the impeachment as another reason to keep fighting Trump, because they will see that as an option that he may go, and so therefore they'd be better off.
I think that's right. I think it's a hard guessing game, but I think the insight we think is that Trump will want to do a deal, but a good deal before the election, because that's what he has to show to the American voters. The Chinese have all the time in the world, providing that the economy doesn't stall too much. Now, the sign we see from China is that it's slowing down also. And so there may be a reason to do a deal for China, not based on politics, but based on economic reason, because the trade affects them also. But the impeachment is playing in their hands instead of waiting and just putting more pressure on the White House.
What about the euro area, the place we...
So the euro is steady, and the euro is steady, and we don't think, obviously Germany is being affected by the trade war, and the numbers are quite slow, but you know, Spain is doing better than expected. France is not doing too badly either. So Europe is sort of more predictable in many ways than the US, but the US drives the world.
Are you one of those people who think that Germany is on the edge of a bit of a cliff? You've got the car industry getting perhaps into a bit of trouble. As you know, the banks aren't doing that well at the moment.
No, we're not. We think the German economy is a supertanker facing some headwinds, and that at some point in time there'll be a need for some fiscal stimulus, and whether they do it enough will be a political...
Do you expect Lagarde to make much of a difference, or do you see her as nearly carrying on in the same way as Draghi?
We think she'll run... we think the right way to think of the ECB is as a board of directors, where decisions are very much spread among people. And so she'll do a very good job at that, and we think the ECB will keep on going on the same direction. And look, there's $17 trillion of debt with negative yield. That's quite something. Not something that any of us had expected 5 years ago. So someone's going to have to deal with this at some point in time.
You run a bond house,
yep.
Perhaps the biggest bond house of all. How do you make money with negative interest rates?
By beating your benchmark, because people still need to allocate to fixed income, and so. Look, $17 trillion with negative yield is a challenge, but things can change quite dramatically. We have this chart of interest rates in this country since the 18th century, where you see period of incredibly low rates and then following period of incredibly high rates. So, you know, the way we sort of think about the world is there's not a lot we can do about the world we live in. What we can do about is minding our business and investing into it, and if we perform over the long run, we'll be just fine.
Do you ever think, there's various things written about the yield curve. Do you think there are particular bits of the yield curve where it's easier to make money, or for that matter, ones you want to avoid?
Well, I think it's hard to make money anyway. I think our greatest concern right now would not so much be the yield curve, is that obviously there is credit in the US, which is priced incredibly tight, and there may be a few accidents in the high yield and loans market, which the market would have to deal with and absorb. And so if there's a sector that we like less corporate credit in the US, given its pricing, than other places.
Yeah, you talked about that in May, I think. You said you warned about that thing, but it hasn't happened. I mean,
no, it hasn't happened.
Corporate credit is still
still incredibly tight. And I think the reason is there's a hunt for yield. And so people who are in the Eurozone who face negative yield looks at the US and say, we want to buy something with a positive carry. But at some point in time, leverage does matter, and tons of leverage do matter. And people will look at specific credit and be worried.
Are there any particular areas that worry you? Is it kind of big takeovers? What is it? Particular sectors?
I think you can look at retail. I think you can look at oil and gas. Businesses and sectors.
Telecoms and things like that.
Exactly, where sectors can change quite dramatically and go from 6 or 7 times tons of leverage to 20 very quickly. So that's something that I would look at. And I think what we all have collectively to do is to think about these things and sort of try to figure out business which can turn.
You've talked, or your people from PIMCO have talked about an illiquidity premium. Can you sort of explain that?
So the way to think about this is to say, okay, I'm a US pension plan, and I need to deliver 7.5. 7.5 is the magic number, because it's the number by which they discount the liability. And to achieve this, I don't think there are any liquid asset which deliver a return near 7.5%. And so people look at private equity and private credit as a way to achieve this. And private credit is something that PIMCO does. And so you basically raise long lockup fund with a 5 to 7 year maturity, and you buy debt that you intend to hold for the maturity of the fund. Now, you may restructure the company, you may trade out of it, you may back it with real estate, you may have a special situation in retail. There's opportunity, and the more the economy is distressed, the more opportunity you have. And I think there are a fair bit of capital waiting on the sideline for the next downturn in the business cycle and hoping to make returns between 10 and 15%.
I don't quite understand how you're kind of keen on that particular area, but you're also worried about corporate credit at the same time. Surely there's an overlap between the two.
Because we hope that they become cheap and that you have an opportunity to buy more at a much better price. So the bonds that I told you I don't like, well, at 80 cents on the dollar, I may like them more. At 60 cents on the dollar, I may like them a lot more. And I think you just need to be patient and just wait for the opportunity, and that's what investors trust us to do.
But does that mean you run the risk of underperformance whilst that happens?
You definitely run the risk in the short term of underperforming. And I think what we tell clients is that we judge us on our long-term performance. We've done incredibly well in 2008 and 2009, and right now we have less corporate credit risk than other people. We've replaced some of this with agency mortgages and non-agency mortgages, and I think we're doing just fine. But if
when do you think this kind of day of reckoning is coming for the corporate credit market?
In a recession. In a recession, and
so maybe next year, basically.
Maybe next year. We think, or U.S. economists think there's a 30 to 35% probability of a recession next year.
But it sounds like you're a little bit higher than that.
No. But 35 is a high number, right?
In the euro area, do you see the same problem, or there isn't as many bonds? Obviously,
there's not as many bonds. I mean, as everyone knows in this room, the euro high yield market is incredibly tight given the hunt for yield, and so you have some of the same excess, but the market is much smaller, and the bank's much more active.
Tell me a bit about, we had that flutter in the repo market, which caused all these problems, and in the subject of liquidity, many people would say, look, if this happened in some esoteric corner of the corporate bond market or whatever, that would be okay. But this was supposedly the most liquid market in the world. You've now had a few kind of weeks to think about it. What's your lessons from that particular?
I think the lesson is it's a technical problem, but it illustrates the fact that banks will care a lot about liquidity going into the year end and may start to offer less liquidity starting right now. And so we need to all think about this and understand that the repo line that one may get affected by how banks think about the capital at the end of the year. That's the point number one. Point number two is the question of, does it tell us something about the economy just like in 2007? And we think the answer to that is no, but it reflects the fact that you had a technical issue with the repo market and the Fed basically not looking at it very carefully at the time, and a very technical situation with a tax bill and all of these things happening at the same time. We wrote quite a bit about it, but we think that the market will be tight for funding for the next few months. And nothing that cannot be dealt with, but that's part of what we do.
Do you think there are possible long-term worries about this? You have the repo market. You've got all the people who are worried about program trading and things like that. That you might now have people who want to re-regulate finance coming in. I mean, when I first met you, you'd escaped from socialism in France. Now
I did escape.
You now got Jeremy Corbyn here and Elizabeth Warren in the United States.
And I may head right back. So I think, I think one of the interesting things is the equity market doesn't price Jeremy Corbyn and doesn't price Elizabeth Warren. I mean, if you look at both of their program, at least on paper, they're very negative for risky assets. And it makes sense, by the way, rates much higher. But for equity, they're just quite negative.
So just to deal with those first, Elizabeth Warren first, have you looked at exactly what the sort of effect of what she's trying to say would have on credit?
Well, from the program that she has on her website, one can guess. What I think we learned the hard way is that trying to make a prediction this early in the cycle in terms of who may or may not be the Democrat candidate, let alone who's going to win, is not a very wise thing to do for us in terms of investor. But yes, her program, if applied and if she was to be able to get it through the House and the Senate, would transform the way the US system runs. Now, we think that even if she was to run, the chances for her to be able to implement everything which she's in a program are low for a whole variety of electoral reasons. And it's unlikely that she would win the House and the Senate at the same time. Quite unlikely.
But here, which are you more scared of out of Brexit or Jeremy Corbyn?
Oh, thank you for this question, John. Well, I'm
not saying you can't get both, by the way.
It's funny. Look, we think obviously that a full-on Labour government with the program they have would obviously be very bad for risky assets, and it somehow reminds me of what I grew up with when in 1981 the socialists in France decided to nationalize everything in sight, and within a year they had to do a 180 and decide that it was not such a good idea. But I think what the core belief that I came to think is that the government is not very good at running things. It doesn't matter how bad other people are, the government is never very good at running things. And so
you see Corbyn as another kind of meteor. He would come in and then run into trouble.
If you look at his program, it's quite extreme.
Do you think that is worse than Brexit? I mean, just in terms of the effect on bonds. You buy a lot of government bonds.
We do, and we like the UK, and we own a lot of UK bank. We think that even in a Brexit scenario, they're fine. So what is
in a hard Brexit?
In a hard Brexit, they're fine, and what you need is resolution at this stage. And I think we are in limbo, and being in limbo is not a good thing. And you have a situation where between the politics, the government, the House, the voters, it's so fragmented and so disconvoluted, and I don't have to tell you this, that you need a way to get to an outcome. And an outcome, even if it's a hard Brexit, is better than having 2 more years in terms of a situation where nothing gets decided.
You'd rather get a resolution.
You'd rather get a resolution. And I understand, for example, that this has drastic impact on political issues, such as the Good Friday Agreement and these things which we really care about. And we grew up in a place where security in Ireland was a big issue, and I fully understand that. And there's no easy fix, but hopefully you get to a situation where there's a vote, and then people can elect the government they want, if it's not a coalition.
The other thing which always comes up is, in the case of Brexit, what the effect on the euro area is. Does that cause you to reevaluate things? Like, if there was a hard Brexit, would that cause you to reevaluate things like, I don't know, Italian bonds and stuff like that?
Depends how much the ECB buy. Of course, it would. I mean, it would slow down the eurozone. But once again, it's a buyer of last resort who's willing to buy a lot of bonds. So that's the one thing that you always need to think about, is that as long as the central bank is buying bonds, the impact in terms of yield may not be the one you think. But the world where Spain issue at 0 rate for 10 years is a bit of a strange world when you have 22% unemployment.
talent war. Can I ask you a bit about your business?
Sure.
You've said that there's a talent war going on, especially on the tech side, and you've set up an office in Austin.
That's right.
Where is the most pressure? Where do you feel the most pressure in terms of other people, talent you want to bring into PIMCO?
Well, we think of our business model as a two-factor model. We try to hire human capital, and we try to invest in technology. And if we get these two things right, there's a good chance that we deliver a decent outcome. And on the people side, we competing against Goldman Sachs. That's okay. I think we know how to do this, and I think we provide a very attractive opportunity. And I think we just hire someone to run a private credit from KKR. We just hire a couple of people from Blackstone. We hire Nick Ranger from AHL. I mean, we're very good at hiring good people from the outside. The one pool of talent where it's much more competitive is the tech side, where all of a sudden you compete against Google and it's free lunch. You compete against Apple. You compete against Facebook, and those are really exciting companies. And we need to be able to draw some of them out and provide career opportunity for tech people in finance that one could not have dreamed of 20 years ago, and that's the challenge. And so we set up Austin. We ran this program where we saw that 90% of the kids finishing University of Texas Austin wanted to stay in Austin, and we said, you know what, that's really, really good for us because they produce 1,000 kids a year who are really good at tech, and we'll hire 20 of them every year, and through time we'll have a really good tech team in Austin.
I can obviously see tech is big, but on the other side, I saw this time last year, I think you told your employees generally to expect flattish compensation, which is one of those, I suppose, euphemisms. Are you predicting flattish compensation in general for PIMCO over the next year?
I think it's a little early to tell, and I think a reasonable thing for me to do is to tell my employees before I tell you, which would be something you would expect.
Tradition.
No. But look, I think the financial industry grows at, the asset management industry. If you look at McKinsey, it grows at a 3 to 5% rate, and so that gives a good proxy for over the next 10 years for what you can think of global compensation, and if there's more people or if there's less people and so on, you can adjust by the denominator. But I think you're facing a world where you have slow growth, and so accordingly, it's just hard to imagine a world where any compensation in the finance industry grows exponentially because it's just not reasonable.
There are many people here might feel the same way, that it's been very difficult to be a fund manager in equities. Because that's an area where everything is very transparent, and therefore the kind of passive side of it has grown enormously. Bonds, as we all know, is slightly more complicated. Do you see kind of passive management coming to the bond industry as the same way as it's rippled through?
So we see them coming in a very specific sector of the US, which is the DC market.
Yeah.
Everything else, our performance is just so much better than the index that I think we can convince people that active management is better than passive management. And I think there's good reason for that. I think the index are constructed in a very strange way. I think that the biodiversity of fixed income is such that there's so many bonds to buy that you can trade one series of bonds for another one on the same issuer and pick up yield. I mean, there's so many things one can do to beat the benchmark that I'm pretty convinced that active management for fixed income is easier than active management for equity. Hence, the results are just better. And we run a couple of position paper on the topic. You also have non-economic buyers in fixed income that you don't have in equity. The ECB buy bonds. That they're bigger than anyone. That's helpful in terms of active management. Pension plan and insurance company own bonds for other reasons that economic reason. Once again, it creates opportunity in terms of arbitrage and in terms of opportunity to buy things. So we use our size to be able to.
Do you think the retail side of the industry will open up at all? I mean, from a retail investor's point of view, bonds will become a...
So I think the one thing which I believe is that for the US and for this country also, the UK, is that retirement is a very big issue. So you have a whole generation of baby boomers who are retiring soon or now, and they have saved, hopefully saved well, and they're going to live longer than they expected to live, and they're going to have to deal with retirement and how to spend the money and find tax-efficient way of managing their retirement account and their brokerage account and make sure they have enough money to live. Some of them may have to work part-time to complement their retirement, but that's a really, really big issue in the US, and I think it's a big social issue. It's the generation of Uber people who work part-time to kind of make meets end at all level of the income distribution.
And from that perspective of a kind of bond investor, just one last question: where do you think of as being the biggest kind of growth area, and where do you think the market is saturated, or the industry is saturated?
So I think the retirement in the US and in the UK is going to be a very big market, simply because people will shift out of equity and buy bonds because they want the predictability of cash flow. Now, they won't sell all of their equity exposure, but they'll have a significant bond exposure. I think that's good for us. And then it's going to be a challenge for us to provide them with the tools and the service and the understanding of what they ought to do and work on retirement issue. And, we hire my old friend Richard Thaler, who just won a Nobel Prize in behavioral finance, to kind of think about retirement and what is the right decision and how do we advise people in the best possible way.
And Asia at all? I mean, a lot of people you talk to in your industry look at Asia as the great opportunity.
We need China to open up. To really make a difference for a large asset manager like us, we need China to open up, because the high growth rate of the big dollar amount has to be China. Japan is great. We have a great Japanese business, but Japan is very mature. Australia and Southeast Asia will never be big enough to really make a huge difference. So China is the land of opportunity. And I can't tell you whether it will open up for people like us. We'll find out.
Manny, Roman,
John,
thank you very much.
Always a pleasure. Thank you for having me.
Yeah, thank you.